Hi guys, welcome back to ValeTalks powered by Valetax. It's nice to see you guys. We know that we were not able to tune in to ValeTalks on Monday. Well, this was as a result to certain technical difficulties and the availability of our guest. I personally wasn't available by the start of this week, but thank God for good health. We're happy to see Kaza back on ValeTalks. Kaza, welcome back. As always, we're going to be, discussing and talking about things relating to the financial market, the foreign exchange world, and we're going to be sharing insights, expert advices, and strategies on how we could become better traders. And for those of our guests watching from far and wide, we want to say welcome back. Welcome back. If you are watching in the nighttime, morning time, or afternoon time, we're glad that you could join us. And don't forget to subscribe to ValeTalks and turn on post notifications to know when new episodes will be airing live. And let's go further into the day. Okay. Today we're looking at something a bit more different. All right. We're looking at the risk management, and this is episode 11. We're looking at risk management, and not just risk management in terms of the charts or technical application of risk management, but we're really trying to understand how longevity and capital preservation works in the market. Where's our head at? Where's our mind at? Psychology, and how to actually prepare our mind to be better traders. Okay, so that is what we're going to be doing today. For today, our guests are Manesh and Sifu. So hi Manesh and hi Sifu. I want to introduce Manesh, and if you're new here, that's why I always want to introduce Manesh and Kaza and other guests that would be having the time. So Manesh is a global market strategist and an educator, and a CFT and CMT engineer with over 25 years of experience in trading.
Recording in progress.
He's worked in the institutional world, and he has also helped in developing the black box systems and is the author of Trading with Ichimoku Client. And we have Kaza. Kaza, it's nice to see you. It's nice to see that you are recovering and you are looking much healthier than the last time we saw you. Kaza is the Global Head of Education at Valetax and is a veteran trader with over 11 years of experience. And he's the author of Navigating the Economic World. He also holds a doctorate major in economics. Thanks for joining us today, Kaza. Thanks for joining us, Manesh. And I am your host for today. Just a brief introduction about me. I am a financial market trader, an enthusiast, and I'm an analyst for the African region at Valetax. I have over 6 years of trading experience, and I'm the founder of the Rion FX Swing Trading Academy. So enough of the yada, yada, yada of myself, but let's look into what our episode is supposed to look like today. So first, we want to talk about longevity as the real edge. Secondly, we want to talk about capital preservation. And thirdly, we want to talk about the long game. So today I'm going to be engaging the host, Manesh and Kaza, on these topics. But before we get started, I want to just give us a quick definition. So risk management is a structured control of exposure per trade and over time to ensure survival, consistency, and long capital growth. And you can see that I've highlighted a very unique quote where I said, the goal is not to win big, the goal is to stay in the game and win consistently. Okay, so Manesh, when people talk about risk management, what always comes to their head first thing is, oh, stop loss. I need to set a stop loss. And that is true on the technical side, because that is the mechanic for actually managing your risk. It's the built-in system that helps us manage our finances in the financial market, right? But I'm of the belief that risk management is bigger than just a stop loss. I personally teach my students to think of risk management first in terms of capital, then before trading balance, and then trading activity. So it's a three-step way for me when I think of, risk management, because your system of risk management could be different from mine, considering the amount of liquidity that you have, in relation to mine. Yeah, relatively. So same thing. So longevity is a real edge and survival creates opportunity. Okay, so this is what we're going to be talking about today. And I want to start out with Manesh. Okay, what do you really think And how do you think traders can stay longer in this game? And how do you think longevity is a key ingredient for being a trader when it comes to capital management and preservation?
Well, I mean, let's take longevity. You want to keep on trading for the rest of your life because it keeps on giving you residual income, right? So the longer you're in this game, the better it is. The problem comes down to every time someone blows out their account, it takes a personal hit on them from a psychological point of view. And the more times you blow out your account, the longer, then you're less chances that you're going to continue to trade. And you really don't want to do that at all. The people that keep on blowing out their accounts are ones that are not using stop, don't understand risk management, as you said, right? And are continuing to just do things with greed. So you kind of have to roll that back. You have to start controlling what your risk is per trade, right? Yeah. So exactly what you said. The risk is not really your stop loss, where your stop is. Your risk is how much are you risking per trade, right? It could be a dollar amount, it could be a percentage amount, whatever it is. And you want to make sure that's controlled. So your stop loss controls if whatever your risk is and your stop is, that controls the number of contracts you're entering. But for every trade, your goal is to keep the risk the same. And that's how you're trading the probabilities in this game. And that's how you survive for a very, very long time. The key thing every trader has to understand is that they cannot control this market. They have to sit there and take what's there. And they have to control the probabilities there. So if your risk is the same per trade, then what happens is that your losers will be the same value, your winners will be bigger, and so forth, where your winners will take care of your losses, and you come out in the long run, and now you're going to survive for a very long time. I personally did not understand risk management at all. I'm an engineer, had a technical background, had programming, so I thought technical analysis was the key to everything. Did that over and over and over, blew out my account so many times. The only way I was able to turn from retail trader to being a professional trader was to redevelop myself. I had to give up my engineering side completely and now focus on trading. And money management, specifically risk management, had to be my foundation. So most people start with building up their technicals and then bring in risk management. And that's when they think it's a stop. It can't be. Your system has to be built on a foundation of risk management. If you don't, you're not going to survive. And you'll probably quit in a couple of years in trading due to frustrations and stuff like that. The markets will give you a taste of winning, and then they'll take it all back from you because you don't have that risk management. Remember, everyone always is in a trade is winning at some point. The question is, are you going to keep that money? Right? And that's the key things going forward. So I really encourage people to understand what risk management is so they can survive for a long time. I've been trading over 20 years and I love it. And I've been consistently profitable, and it's all due to risk management. And it's not due to the stop loss, it's due to my risk per trade being the same. So I'm trading the probabilities in this market and taking what the market gives me, not trying to get more.
Well, thank you very much, Manesh. I heard you say something about money management, and then you said specifically risk management. So in a very short sentence, I want you to kind of like break down the difference between money management and then how risk management is a part of that money management.
Yeah, so in my mind, and remember, everyone could view things differently, the words, right? So money management to me is how you're managing your entire account, okay? Risk management is a subset of money management. So when you talk about risk management, that's looking at each individual trade. So for me, I look at a chart, I know where my entry is, where my stop is. So the difference between my entry and my stop is my risk, okay? And then if I have a $200 risk per trade and my stop is $50, or $1, then tells me how many contracts I can enter. So the risk management tells me how many contracts I can enter and keep my risk the same per account, okay? Money management basically is what tells me what my risk per trade is going to be. It tells me what percentage of my account I'm risking in the market. So for me and my students, I always encourage them only to have be 20% of their entire account in the market. So if you put $10,000 into an account, then 20% you're going to be having active in the market. And if you're assuming that with your back test and everything, that you're going to have 10 trades at one time, then what's going to happen is the 20% of 10,000 is $2,000. Then you're going to have 10 trades at one time. So your risk per trade is going to be $200. So that's the way we look at it. You could do it instead of a dollar basis, you could do a percentage base too. But for me and my students, I do not encourage investing more than 20% in the market, especially the way everything is now with leverage and all that there. And let's say you have a black swan event, right? And you lose 20%. That's it. You still have the 80% there to keep on surviving and keep on trading for another day. So we're preparing for the worst case scenario there, where you only have 20% in the market. So if we have a black swan event or something happens, the stop goes array, whatever, you lose only 20% of your account. So now you have 80% to still keep on trading and moving forward. And if you're looking at 3-to-1 reward risk ratio, that 20% can grow exponentially with that 3-to-1.
That
So
makes a
money
lot of sense.
management is the reward risk along with risk management, two components of everything.
Perfectly said. Perfectly said. Because that's the same thing for me. Yeah, it's where I always say I think of risk management, off the charts and on the charts. And when it comes to off the charts, it's about how much you have, as a person and what you're willing to risk overall. Yeah. So it's about the same thing for me, just put differently. I'll probably say maybe in even a better way. Kaza, what's good? You look like you've just been eavesdropping on our conversation.
Yeah, because it's been a long time that I attend this podcast as a host. So yeah. I'm waiting for you to ask me a question. That's why I just dropping you, man.
Yeah. So looking at from everything Manesh has said, about longevity in the market and what the key factors are for longevity in the market, what would you want to add to that? What would you say is like as a key element, an ingredient in the market when it comes to longevity? Do you think it's just risk management on the charts, or do you also have the idea of money management first before risk management?
Thank you, Rion. You and me, we are both retail traders. We are different from Manesh, and and our mindset or our psychology is to think about risk management and money management is totally different from the institutional point of view, right? Because as a retail trader, we doesn't trade using a big amount of money. 20% of our capital maybe is $20, not 20,000 or $2,000, right? So longevity for me is equal to survival, right? So if we analyze trading from a professional perspective, longevity is essentially a function of control exposure over time. So market operate in cycle, right? So we have expansion, we have contraction, we have volatility, we have liquidity shift. So a trader who survives across multiple cycles develop something more valuable than a short-term winning streak. So a lot of traders, they always want a short winning streak, like both of us, right, Rion? We want a short-term winning streak. But when you took long enough yourself in a trading journey, you will have this market cycle. You will go through this market cycle and you will develop one thing. It's called adaptability, right? So you will adapt with every market cycle. So when you have this adaptability in whatever market that come to you, you will have that mindset to have the good risk management, to have a good money management, right? But for me, I'm a bit different. When we speak about money management, right? Um, First of all, I will teach my student, if you have just, let's say, $100, right? And you want to talk about risk management or money management. $100, you cannot talk about money management or risk management at that point as a retail traders. This is a fact, because it's $100. Whatever money management that you talk or you advise them, even they put 1 cent in the account, it will blow up if that they are putting a different pairs or a different trend, right? So many traders focus on edge as a technical advantage, but statistically speaking, even a strategy with a positive expectancy can fail if risk exposure is excessive. So, like Manesh said about risk management, a lot of people, Manesh and Ryan, they understand risk is RNR, right? Risk and reward
risk to
ratio.
reward.
We call it RNR, right? Risk and reward ratio. So some of the gurus here in Southeast Asian, they always teach their student to get 1 to 20, 1 to 100. Seriously. Why? Because the fact that I said to you earlier, because a lot of these traders, they only have $100 or maximum is $1,000. So if they want to talk like, okay, you have to have a 1-to-1 risk management, right? So if you have $100, you need to practically lose $10 to win $10. So what can you do with $10? That's the mindset of retail traders. So that's why longevity only will come to a traders if they adapt to the market. For me, I'm so sorry, Manesh. For me, risk management and money management is good, but you need to see the capital that the client have. For me, if you have the capital more than at least 5,000 and above, we can talk about money management or risk management. But if your capital is lower than that, money management and risk management is still important, but it's not a crucial thing for them to think. The crucial thing for them to think is how to survive the market. So they need to adapt the market cycle. They need to adapt when the CPI came. They need to adapt when the crisis came. They need to adapt when the war came, right? When they adapt to this market cycle, so they will know psychologically to enter the market or not. So for me, as a traders, when you talk specifically on the retail traders, that is how you will survive in the trading industry. That is how longevity is mean for a retail traders.
Thank you very much, Kaza. So I like how you came down to like the crutch of retail trading, because that's true. Like retail traders usually have this mindset of, oh, I don't have so much money. So you telling me about how to manage my money. The only reason, in fact, for a lot of retail traders, the only reason why they are trading is because they're trying to make money. They're not trying to grow capital. It's not about capital preservation for them. There's a popular saying that when you're broke, you want to look for risky opportunities to make a lot of money. And when you're rich, you want to look for less risky opportunities to make little money. And that is how, wealth is compounded. So someone with $1 million USD just needs to put in 150,000 in a mutual fund or in a trust fund that gives him about 16% at the end of the year. And that is a steady, income from somewhere. He has the ability to keep that money aside and he's just earning 16% or 20% from it. That's good money for him. But for someone who has 1,000 up and above, that's the only money he has. When he's taking 200 USD out to actually get into the market, he's not thinking about how to manage that 200 USD. His first thought process is, how can I make this 200 USD become 20,000 USD. So risk management usually is off the books for them. And the average retail trader doesn't have a mind of compounding. The thought process for them is, how can I make this profit now? How can I do 1,000x of my account, 200x of my account right now? That's the thought process. And that's the essence to why we're having this call right now, is to help them understand that, yes, risk management is important. It is very much important. And we also understand the importance to actually, make a lot, of returns on your account. But at the same time, what we're saying is, we're not asking you to manage your risk like a billionaire. We're asking you to manage your risk so you don't have to start from ground zero again. So as much as you want to 100x and 50x your account, it's important that you also try to imagine what tomorrow would look like, because only he who has something to compound today can compound tomorrow. So if you're back to zero, now you're going to think trading is a scam and you're going to just be broke all over again. So I think that is like my own view. And, this is me trying to piece Manesh and Kaza together to feel smart. Yeah, I hope I did feel smart.
For today podcast, I will be a bad cop. So because this topic actually,
right?
Pardon?
That's why we have ValeTalks, to get all the different opinions.
Right? Because you must understand that survival precedes growth. You can talk about growth to traders that have a lot of money, like 5,000, 10,000, or they doesn't think trading as making money machine. If you talk to a traders that think trading as a money making machine, they need to be taught about survival, not about how to grow their money, how to take risk management or money management. That's not important for them. As a trader, for me, I always teach people on how to survive in the market in a long run, 10 years, 20 years, 30 years, right?
I have a different view, but I would skip it to the next part. So let's just quickly go to the next part, and then I'll tell you a view that I have regarding this thing you just said. Yeah. So so the next thing we're going to look at is we want to look at capital preservation. Okay. So I just put here, I said protect before you pursue. Like Manesh clearly stated, I think this is a walk through or walk around, or walk in the park, anyone we decide to use. Because Manesh already mentioned it, you want to have a fixed risk per trade that helps you manage the amount of money you're losing. So if you're doing a 1:3, which is a very good risk to reward ratio, if you have 5 losses out of 10 trades and you win 5, you're up 15% and you've lost only 5%. So overall, when you do your P&L balance, you're up 10%, right? So you're up 10 times what you've lost, or 2 times what you've lost, rather. So control daily and weekly drawdown, position size, adjust to volatility. So for instance, people trading things like gold or BTC now, it's heavier, silver. So you want to kind of cut down the lot sizes to match the volatility and presence of liquidity on these pairs, right? But with that being said, with this being said, let's roll back, because I think we kind of discussed this in the first part of what we're talking about. So let me just share something to us to kind of match this. And then I would be using what Kaza said about survival, because I think it's very important. And so let me stop sharing this quickly. Okay. So Kaza said something about survival preceding growth. Now, I very well agree with you, because at the end of the day, survival is the first point of everybody trying to create financial stability or wealth. You have to come from survival. You have to come from a place where you're literally struggling to go hand to mouth. Then you go from hand to mouth to being able to pay for your daily and easy bills before you finally move into comfort and all of those things. Now, survival is the first instinct that a human being has that leads to why he wants growth. So you're right on that. I completely agree with you. But if we're going to also teach them survival, we need to understand that survival is the first ingredient to staying long in the market. So whether you're a billionaire or you're a millionaire or you're just a 6-figure trader, it's important that you still have the survival mindset. Like Manesh clearly stated, you can't toss the survival mindset in the trash. It's like the laying foundation for everybody in the financial market. Billionaires don't want to lose money. In fact, it's because of the same survival instinct that makes them work even 3 times harder than they worked when they just became a billionaire to make more money. It's all survival. It's not from comfort, right? But retail traders need to also understand that survival shouldn't push you to a point where you get overly ambitious and you lose your account. Survival should protect you from that level of ambitiousness. So it's more of a mental thing. Yeah, it's more of a mental thing. It's more of a mindset thing. Because think of it this way: if I had only 500 USD up and above in my bank account, and I decide that I want to trade, and I put 500 USD into my trading account, as much as I know that I am trying to make as much returns on this money so that I can, level up my life and everything, my survival should be coming from a place where it's about how do I make sure I don't lose all of this money, but still make money. So that changes something in my mind at that very point in time to understand that if I lose this money, I go broke completely. But if I treat this money from the place of survival that allows me to manage this money properly, I can grow it. So I think the shift I'm trying to preach is shifting from survival that makes me overly ambitious and makes me lose regard for my risk management to survival that helps me appreciate the importance of risk management. I don't know if that makes sense to you, Manesh.
Yeah, it does. You want me to answer or you want Kaza to go?
I can't see Kaza any longer. Is he still on the call?
Okay. So, survival is the key, right? And everyone has different opinions, right? For me, it's a different scenario. A reason why is I made a lot of money as a retail trader and then I blew out millions, right? So it taught me that, the retail mentality is not really the way to go. So for me, it's about creating habits from the very beginning. So, this is where I differ from Kaza. I understand retail traders may only have $100. But if they have to survive, they've got to set up their foundation at the very beginning, even with $100. So with $100, if you if you put it all in the market, leverage it up and this and that, you can blow out your money or you can make a lot of money, right? You're letting the dice roll. But the problem is every time you do that, you're setting up bad habits to a point when that account does grow. And as you said, then you bring in money management, risk management. It's hard to do because you raise that and let the dice roll, and that's become a habit. So for me and my students now, and I don't care how much money they have, if they have $1 million, I tell them not to put $1 million in the market right now. The key is to set up your foundation and your habits correctly the first 90 days. It takes 90 days to set up the habit. And so I encourage them to only put $100 into their account, $500 into their account, no matter how much money they have, and learn how to manage that $100 and $500. And when you do that and you don't have much money, a couple of things happen. You learn about risk management, but not only that, you learn how to pick the best quality trades. So if you have a lot of money, you're going to do a lot of trades, or you may do a lot of contracts and this and that, and greed kicks in. So I don't want that at all. I want them to, out of the currency pairs, let's say the 25 major currency pairs, pick the best one to trade today, right? So they know how to pick quality trades versus quantity. And if they pick the quality trades, now they have a higher probability of winning, right? And you have a higher probability reward risk. So for me, learning these things with $100 is key to set up your foundation and habits for you to grow your account. I understand it's frustrating for retail people because they want to 5x their account, 10x their account. But at the end of the day, how many people consistently triple their accounts, double their accounts at the end of the year? You don't see that. Very rare, right? Institutions, if you look at it, talk about a 20% gain in their account, 30% gain, and that's high for them. How many retail people really are making that much consistently year after year after year? And you don't see them doubling their accounts, tripling accounts. You see it on one trade, two trades, but then they'll give it back, right? But the key here is consistency and longevity, right? So that's what you want to gain. And really, it all starts from your technical analysis, your back testing. Your back testing will tell you what your drawdown per trade is going to be during volatility times, non-volatility times. So you're going to know your best case, worst case, everything for your drawdown. You're going to know how your system reacts with everything. Those statistics will tell you how much you could risk per trade, how you're going to do everything, and so forth. So you could do things and adjust your money management, your risk management, reward risk, based on your back testing results. So it has to start there where you know your statistics, and those statistics will come into the money management play. So for us, if we find a technical system that doesn't give us a 3-to-1 reward risk ratio, we're not going to use it. It's not worth our time at all. So if the back test does not show you a 3-to-1, we're not going to use it because we know we're not going to survive in the long term. Because without a 3-to-1 reward risk ratio, there's no way your winners will take care of your losses at all. So that's what we're looking for. Okay. Then next we look at, okay, in the back test, what is our drawdown? Right? If we see exceed drawdown with volatility, then that's not a good system at all. So our statistics and our technicals tell us a lot of information to a point. We then use that into the money management and so forth. And that's why we could sit there and control the money management, because our statistics of our technical system told us what they are, what they have been in the past. Doesn't mean it's going to repeat, of course, but we're assuming that. So for us, it's more about that. So it's not trading that way. Our goal is to set up habits from the very beginning. Because if we do not set up habits from the very beginning, then it's going to be hard to change them later. And that's what happened to me. And that's one of the reasons why now, it doesn't matter for us. If you have our goal is you should take $100 and grow it exponentially, not overnight, not triple it, anything. If you're thinking you're going to get a 5x on your account tonight, then you're really gambling and you really don't have the foundation and mindset to win. So, the goal is to control that, right? And then move forward. Like we just put out a video, we had a social media essay on Kaza, where you go in with a $20 risk and you got an 11-to-1 reward risk ratio. And if you didn't use leverage, you walked away with $50 or so. If you use leverage, you walked away with $250, right? So it's a big difference, right? So with leverage now, you could do a lot, as long as your technical system tells you what your drawdown is. So you could take $100 with the leverage, still have a $20 stop, and make a lot of money with leverage. Whereas years ago, you couldn't do that. Now you can, because you have the ability to do 100x, 200x, and 300x. So you could take advantage of the leverage with $100 and still have the risk money management. And as long as your technical system is timing based, then you can sit there and grow that account pretty good. So it's a different perspective, but for me, it's setting up the foundations at the very beginning at $100 and going from there.
That you see, it's exactly the same thing I was saying. It's all about mindset, right? It's all about mindset at the end of the day. And I think that's what makes it interesting. That's what makes it interesting in the grand scheme of things. Kaza, I see you had a network glitch.
Yeah. My laptop has a problem, so I'm using my computer now. Hopefully it's okay. I don't know why. Maybe it's because I didn't join the podcast for 3 episodes or 4 episodes, so the laptop has a problem.
Maybe you're getting punished. But so I was just telling him. So I'm just going to give you a quick rundown of what I was telling him before we move into the next item for today. So I was just telling him that I think the whole thing about risk management and survival is a mindset thing. For some people, for me, I see survival as getting to a point of not going back to where you came from. That's survival for me. And because of the thought process of I don't want to go back to being broke, it helps me make certain decisions that are not irrational. It helps me make more rational decisions. For some people, survival is I would, because of where I know I'm coming from, I'm going to go hard or go home. So it's either,
Yeah.
I make all the money right now or I don't make any money at all and I'm fine with that. So
Yep.
it also comes from a place of where, you're positioned at. So for someone like Manesh, who is a family man, has kids, has a wife, has dependents. His idea of survival would differ from a young person who is just leaving college or university and doesn't have so much money.
Yep.
So the person leaving college can decide to blow up everything. But Manesh is looking like, if I lose everything, I have dependents, I have people who I have to take care of. And similarly,
Yeah.
you've spoken so much about, how much you like to take care of your parents. So when you're thinking in survival mode, your own approach to survival is going to be not wanting to lose money because it would affect the people that you have to take care of. So you see that the idea of survival is kind of tricky and is highly subjective to who is in that survival mode at that point in time. So that was just what I was explaining to him, that I think is more of a mental and mindset thing than any other thing. So yeah, moving on. Let's see what the next thing we have to look at is. So yeah, the long game. For me, I said consistency beats aggression. Small losses are business expenses. I think it was. I think that was it. Mark Douglas or may his soul rest in peace. He died middle of last year. Very popular trading psychology trader. I'm trying to remember his name. His videos are very popular online. He was the one who said you need to see the losses in trading as a business expense and not just the price you pay for learning. You also want to avoid revenge trading. Protect your psychological capital. So psychological capital in the sense of, it's not just the money you're trading, it's who is trading that matters to as a trader. So you need to protect yourself too. Because if you keep making consistent losses, you're going to keep drowning yourself in a lot of sorrows. So let's talk about the long game. Kaza, what do you think are some of the things that a lot of traders need to avoid when it comes to trading in general?
Fundamentally, if you want to talk or you want to speak about long run, long game in trading, right? We first of all we already talk about survival, right? So
Yeah.
as you can see, I just give a fact in Southeast Asia itself, the survival rate as a trader is like maybe 10 to 20%.
Yeah.
So there is a word that we used to use as a trader is 90% loss and 10% profiting. So that 10% is the one that survive for so long in trading game. So actually, if you see trading fundamentally, you can say that no single trade define performance. Am I right?
Yeah.
Whatever trade that you're doing is not, you cannot define it as a performance, right?
Yeah.
We define performance with consistency, with a good attitude, with a good mindset, right?
Yeah.
So one thing that traders cannot do is short-term aggression. As a traders, they always have this kind of mindset, like you said, Rion. If a trader is just a college boy that have just a small money, right? So what he gonna do with the money? He will risk everything. Go. What is the word? Go home and go what?
Go hard or go home.
Yeah, go hard and go home. If you're a college boy and you only have like $100 or $200 in your pocket, you will not see trading as a what do we call it, as a business. You will
Yeah.
see it as a money making machine.
Yeah.
So you will risk everything, and then you will pray for to the God to win at least 100 200%, right? So
Yeah.
short-term aggression may generate isolated high return, but without structural discipline, is eventually will dominate your mindset, and over time you will have risk mismanagement, and you will have a very very bad mindset as a trader. So
Yeah.
can what should a trader not do if they want to be a long game traders or a survival trader? Is one, understand trading is a business. That first.
Yeah.
I think Manesh always said about this, that trading is a business. Trading is not gambling. Trading is not a money making machine. Trading is not a casino, right? Trading is a business. So when we talk about business, there is a risk that you must take, and there is some limitation on the reward itself. So you, as a trader, you must understand that. So to survive in the trading, for me myself, Manesh and Rion, this is my 12 years in the market. I'm losing, I'm profiting, I'm losing again, and I'm profiting again. And it's just a cycle of life as a trader, right? But I just want to correct one thing when Ryan said I don't want to lose money. I always lose money, right? But the important thing is do not lose everything.
Yeah, that was my point exactly. Yeah, you wouldn't want to lose everything. I mean, losing is a part of the game for you,
lose
right?
money is normal.
But you wouldn't want to
money,
lose to a point where you go to zero.
Yes, losing money is normal in trading. Losing money is normal in business. Even Manesh has lost a lot of money in the past 20 years, right? But
Oh yeah.
you don't want to lose everything. I have at one time in myself 5 to 6 years ago, I lose everything just because I see the market is following my say. Right? When I see gold is going down at that time, like 500, 600 pips a day, I dump all my saving and I put everything on the risk, and I lose everything. So to be a long-term traders, a survival traders, you need to consistently making profit and consistently understanding about the risk. So risk management is important, money management is important, but as a small retail traders, Manesh, we are not thinking to buy a house in the next 10 years. We are thinking about how to pay for our fuel tomorrow, pay for our lunch tomorrow, right? So that is survival for retail traders.
Yeah.
So as a retail traders, if you want to survival, first of all, is capital preservation. You need to have a good capital preservation. You need to know that if you lose this money, you can survive for another 3 weeks, or for the you can survive until the next salary, right? Because 99% of retail traders is still working. They are not a full-time traders. So that is how I say, if in the long game, fundamentally as a trader, what you cannot do as a trader to survive is you cannot have an what do we call it? You cannot have that mentality to buy a house tomorrow. You need to have a mentality what to have tomorrow. What lunch do you want to eat tomorrow? The mentality not to become a rich people, just a mentality to become a long-term traders, to become a survival trader. So in a professional capital market, institutions survive not because they avoid loss. Am I right, Manesh? They not avoid losses, but because they control the loss magnitude and relative to total capital that they have. So the same principle apply to individual or retail traders.
Yeah.
So actually, in short way to understand, longevity and a long game provide statistic advantage, preservation, protect capital integrity. So in a long run, in a long game, they ensure that structured discipline translate into sustainable growth. At the end of the day, like I said, survival precedes growth.
I totally agree with you, and I am in no way even going to defend that because I think as retail traders, the goal isn't first to the goal shouldn't be because right now it's a different story entirely when we come into the real world and look at it. You see a lot of retail traders wanting to buy a Lamborghini in 1 year. They want to, no risk, no Ferrari.
Yeah, that kind of traders is making a bad impression on forex industry for the past 5 to 6 years. They are a bad apple in this industry. Sorry to say, but because for us, for both of for the three of us, we have managed to survive for 20 years, 12 years, and 6 years. We will totally understand that if you want to survive this industry, you cannot think yourself as a crazy rich Asian or crazy rich US or crazy rich Nigeria, right? You need to think yourself as a small business owner, right?
Yeah.
I always use this methodology. If you open a small coffee shop in the middle of nowhere, but your mindset is you want to profit like a Starbucks, it's nonsense. It is really nonsense, right? If you're a business owner with a small coffee machine and only a 5 cup a day, you need to think the profit is 5 cup a day, not 5,000 cup a day. You understand what I mean, right? So that's the methodology that I always use to my student. That they always ask me, Kaza, how can I be rich with trading? I said yes and no. Yes, if you have a lot of capital. No, if you have a small capital. It's just that simple. Even in business, if you have a lot of money, you can get rich fast. If you have a small money in yourself, you can get rich, but step by step, right?
Yeah.
But
step by step.
Whatever happens, survival is important. That's all.
Very much important. Manesh, you want to add anything?
Yeah, just a couple of points in Kaza's. One, if you don't, whatever money you put in the market, you should expect to lose. So if you can't afford to lose that, then you should not be trading at this point.
At all.
Right?
Yep.
Yeah, so that's one basic assumption. The second is exactly the different mindset of all the different people, right? Are you looking to become rich or are you looking for consistent profits? Be consistent. So that's the big difference between the mindset of a retail trader. What is their goal, right? If their goal is to become rich, then believe it or not, that's a short-term goal. And if it's to be consistently profitable and to get money out of this market, then that's a different scenario, right? So the people that want to get rich overnight, they typically are gamblers that typically do not make it in this business. The people that want to sit there and be consistently profitable, that's the ones that will survive. So it depends on the mindset you come to in trading. The people that want to be consistently profitable, then you do have to trade this as a business. It doesn't matter if you have $100 or not, you have to do it the same way, right? It's just like, as Kaza says, you starting up a coffee shop. If you go to a bank and just say, hey, give me money for a coffee shop, I'm going to give you 20% down, they're not going to give it to you. You have to give them a business plan. In that business plan, it shows the research of why that coffee shop would work there. Then it defines how much money you need, what you're going to do with it. Then you give them metrics. You may give them quarterly metrics, yearly metrics of what you hope to achieve based on the history of the research you did. Same thing in trading. You have to give them a trading plan. You have to have a trading plan. It starts with the back test. The back test, believe it or not, gives you all the metrics that you need. Okay. And once you have the metrics that you need, now you could create a trading plan based on those metrics. You'll define what your reward risk is, what your risk per trade is, how many trades you could take per week or per month or per quarterly, what your drawdown for a week is, what your drawdown for days, what your drawdown for a quarter is. What are your metrics? What are your goals, right? And it shows you, and then your goal is to implement that trading plan with no emotions. Now you do that. Now you will take the steps from going from retail trader to being professional, and you'll start even being consistently profitable. You have to set up those habits from day one. If you don't set up those habits from day one, later on, right, it's hard to unprogram habits and then reprogram yourself. And that's the hardest thing to do. So you have to take your emotions out. And the only way is to have your trading plan and to implement it. If you have a trading plan, then I know you're going to survive long term. If you don't have a trading plan, the probability is you're going to be that 98% of that retail traders that fail. And that's the way I look at it completely. I know that's different from a mindset of a retail trader that's, wants to be rich overnight. I understand that, but that you're not going to survive that way. And I tried it for years. I thought it would work the same way, and it didn't. And that's where I lost millions and had to reprogram my mindset. And when I had to reprogram my mindset, it was the most difficult thing to do, literally, because you've been sitting there trading for all these years with one certain mindset, and then you blow out your account a couple of times. And at that point, it finally woke me up. And it took me probably 3 or 4 times to blow up my account to finally make me change my habits. And then when I did start changing my habits, I realized it's not easy. And I had to take it step by step. And the very first thing I did was started creating a trading plan in 2000 after I lost everything, and consistently making sure I follow that trading plan. And your old habits will make you deviate from it, but every time I deviated, I got hurt. So I learned with time to follow my trading plan and go from there. And believe it or not, I did start with $100 back in 2000 when I lost everything, and I grew it. And it actually helped me because when you don't throw money at the market, you learn how to choose the best quality trade. So if you don't have much money and you can only trade one currency pair, which pair are you going to trade? Which pair is going to move today, right? And if you could get to that level, then you're going to be good. And I always did things like habits that I have even today. If I don't make money in the morning, I don't eat lunch. I'll eat a protein bar. If I don't make money in the evening, I don't eat dinner. I'll have a protein bar. So I made sure I was hungry and be consistently profitable and following my trading plan. But it was just things I created to become habits. And that's literally what helped me grow and come back. And I started with the correct habits when $100 and just slowly started growing it, was not thinking of that mindset of becoming a millionaire as I did. And at one point I did become a millionaire and I lost it all. Right? So what goes up with volatility will come down the same way.
Very much true.
Life, it's the same thing.
Well, this was really insightful to help people know that, because I think every good trader you see today has gone through that cycle. If they haven't gone through the cycle yet, now this is not a curse or a bad prayer for them, but if they haven't passed through that cycle yet, it's just on the way. I believe that every good trader you see today has had his own fair share of, top to bottom story. Because I went through mine too as well. Late 2020, early 2021. I believe I told us in our episode 2 of ValeTalks, we spoke about it too as well. I think every good trader you see today should have, in one way or another, gone through that experience. And I think that is the what's the word? That's the curious moment for every trader. It's at that very point you realize, so I think I need to be more disciplined. I need to have a habit. I need to understand the market more, and it's important. So dear traders at home, if you're watching this, I hope that, what Manesh just said and what Kaza have been talking about really means a lot to you. And I hope you're learning from it. And I do hope you come back to this episode, because I feel like this episode is filled with a whole lot of, psychology and mind discussion that would help you reshape and restructure your identity as a trader to know the right places to be in and the right things to do when the time comes. So I just have 3 takeaways for us today, okay? And I would say number 1 is I want to say longevity is more powerful than short-term gains. Yeah. So as much as you're a retail trader, when I think sometimes when we say long term, retail traders like to think we're talking 3 years, 10 years. No, as a retail trader, you could think long term in what would your P&L look like at the end of the month, not just tomorrow. So think of your P&L developing at the end of the month. Okay, at the end of, if I make 10 losses, that's fine. If at the end of the month, I make another 20 trades and I make 15 out of those 20 trades, because of my risk to reward ratio is good, I would end the month profitable. That should be like your major concern. Number two is capital flows determine the winners and the losers. So meaning that you need to see where the market is going to. You need to understand where the capital is flowing to. So right now we're looking, a lot of traders are looking at gold and there's a lot of confusion. And I've stated it clearly that gold doesn't have a direction to be specific right now. We've seen the market be bullish for over a year. And at this point in time, it's the law of market cycles. We're currently in a consolidation. Prices are going to keep going up and down the hill till it finally decides on what direction it was going to get to. So you need to know where the capital is flowing into, and then you position yourself. Number three is discipline. Discipline in rigs builds confidence over time. And what this means is the more disciplined you are, like Manesh said, the more you practice a fixed risk system. Okay. Now, I'm not saying everybody should practice this. Of course, if you must, at all costs, if you want to have a flexible risk system, but just make sure that wherever it is, at the end of the day, your P&L remains steady. It remains in an upward trajectory. It doesn't have to be perfect. It could look, and it's going up this way or going up that way. The most important thing is up should be the only direction where you're aiming for. And with that being said, I think that's all I have to impute for today on ValeTalks. And I hope that this podcast today would really help a lot of people. If this is the first time you're watching this, please don't forget to hit that subscribe button for ValeTalks and turn on post notifications so you get notified on the next episodes for ValeTalks. What's up, Kaza? Is there anything you want to add, or do you think we're good?
I don't want to add anything. I just want to say that in this podcast, you can the audience can see the difference between retail traders and Manesh as institutional traders.
Yeah.
But we are not that totally different, right, Manesh?
Yeah.
The risk management, the money management, this and that is just the same. The difference is we don't have the same capital as you. We doesn't have the same mindset. Like, if I have $1 million in my trading account, right?
Yeah.
The mindset that I will have that time is not to think about what to have lunch tomorrow, what to eat tomorrow. If I have $1 million every day, I will only think where I will travel today, what I'm going to buy today, right? So that is the mindset. But if you want to get that mindset for retail traders, the easiest way for them to understand risk and the easiest thing to explain to them is, if you want to be a good trader, risk management is, for them is, I don't want to use that harsh word. For them is nothing, because they think money management and risk management is not helping them, because they want to get money for tomorrow, right? I always teach my student, if you want to start trading with a small amount of capital, right? First of all, the first question that I will ask them is that all the money that you have? If yes, I will not let them to be taught by me, and I do not let them to be traders at all. Because why? Because if you have that, if you only have that money to survive for the next salary, and then you want to use that salary to risk it all in trading, for a fact, we know 99% of traders are losing and just 1% is profiting. Then what's the point to become a trader, right? So for me, my advice to traders, retail traders, is that if you want to start trading, first of all, you need to start with your mentality, with your goal, with your perspective of trading. Don't see this, sorry to say, fake gurus in social media showing off big house, big car, travel in Dubai, stay in Burj Khalifa whatsoever, and you don't understand whatever that they are saying behind the scene, right?
Yeah.
Because I've seen a lot of these traders in social media, and they're attracting millions of dollars of deposit, and
Yeah.
eventually for after 2 months or 3 months or 6 months, this million of dollars is converting to zero. Why? Because they see in the social media, oh, just become a trader, you can buy Lamborghini. Just become a trader, you can have a big house and so on, right? So
Yeah.
change your mentality. Understand what you need in trading. If you need, if you join tradings just to survive, then survive. If you join trading to become rich, you can be rich with a realistic capital, right? Manesh, what is a realistic capital to become rich?
But I know we're running out of time, so I'm just gonna keep it simple. It doesn't matter how much money you have, over $100, $1,000,000, and so forth. It doesn't matter how much you make. I'm a firm believer your mindset has to be the same. You cannot become materialistic. You can't do anything like that, but because your mindset has to be the same. So,
Yep.
I'm a firm believer the mindset has to be the same no matter how much money you have or how much money you're making, period. So I'll wrap it up with that.
Nice.
All right, then. Thank you, Manesh. For me, I would say there's no amount of money that you can put to get rich immediately, because at the end of the day, we all have a money mechanic in our head that helps us know, if we're going to make more money or we're going to lose more money. At the end of the day, making money is from the mind. It would take someone lesser time, it would take someone more time, but ground matters, knowledge matters, exposure matters, and all of these things are really very important to make money, even in the market. Yeah, someone who was living in the same house with Manesh. If I was living in the same house in Manesh, probably I'll be worth over $500,000 by now because he's made $1 million. So I'll be closer to him, and his lifestyle would inspire me, and his knowledge will pour on me too as well. You get. So thank you guys so much for tuning into ValeTalks. It's always a pleasure to have you guys on the call, Manesh, Kaza. It's always a beautiful moment. I learn a lot when I'm on this call with you guys, and I cannot take it for granted. And to everyone watching at home, I hope you had a great time. Please make sure you come back to this episode. Very important episode, and I believe it would help you if you ever feel lost in your journey. Until next time, it's Rion, it's Manesh, and it's Kaza, and this is ValeTalks. Bye, guys.
Bye-bye.
Bye.